Debt is often regarded as among the most notorious financial instruments in recent years, due to the concept being politicized, a concept that is blamed for collapsing or endangering one's economy. Although such a concept has indeed played a role in threatening society, it does in fact not show the entire story. Debt, whether taken domestically or from foreign entities, has always been a huge economic driver. It has brought in a miraculous term known as credit. It is a financial concept that allows a business or a country to build infrastructure, buy a machine, or initiate a program that they could not initially afford. Debt's only issue is that sometimes they are plagued with mismanagement or even interfered with political corruption. Hence, its supposed economic contribution has rather been an economic burden. Across the world today, there are many nations plagued with unnecessary debts driven by instability and failed governance. Malaysia is one key example of this. The country has been under the spotlight due to consistent scandals. One of them is the notorious iyanbriandi, which has been cited that the government has assumed the debts owed by the Wealth Fund. A fund that was supposed to reap benefits ended up being a burden. However, the debts of iyanbriandi are not a simple concept, since it is composed of many variables. If we take a look at Malaysia's overall debt, there are factors such as the interest rates from those debts, what are the terms and conditions, and where those debts come from. The most important factor around debt and its feigned face is linked to external debt, sometimes known as foreign debt. This is because Malaysia's own external debt has been cited throughout many media and official results to be fairly high. And as known throughout, foreign debt does indeed pose implications if unhandled properly. To understand whether Malaysia is in a position of debt or not, let us discuss all of these in detail. As of the latest data, Malaysia has the third highest external debt in the entire Southeast Asian bloc, registering over 250 billion US dollars, or more than a trillion Malaysian ringgit worth of external debt. This is a figure that is higher than Thailand, which has only 194 billion dollars, and the Philippines only at 106 billion dollars. But below Indonesia and Singapore. However, when we actually compare this figure to the country's nominal GDP, the entire story would rather look far different. The external debt to GDP of Malaysia stands at around 66%, which is a figure that makes it the second highest in the entire Southeast Asian region. This then leaves us with the question, why is Malaysia's external debt so high, far higher than most of its neighbors? Is it due to Malaysia's prominent rise as an economy that has surpassed these developing countries, or was it related to Malaysia's political instability, such as the iyanbriandi? Or other similar scandals? Well, to understand all of these, we must first see what these external debts truly are. Malaysia's external debt is estimated to be higher as, according to the latest data published as of the second quarter of 2022, it is around 1.12 trillion Malaysian ringgit, or 250 billion US dollars. This figure has steadily been rising for more than a decade now. Back in 2009, it was only around 364 billion Malaysian ringgit, or just 80 billion US dollars, and it took only a decade for it to grow to where it is today. The entirety of the debt, however, is not what most people think it is. In fact, external debt is the sum of both public and private debt, meaning that when the government of Malaysia borrows money from overseas, it is registered into this, and if the private corporations of Malaysia also do the same, it too registers into the entire external debt. This can already tell us that while Malaysia has a huge external debt, it is joined by other parties. As of the latest data, the amount of money the federal government, public enterprises, and government securities issued to non-residents as a form of external debt is approximately 339 billion Malaysian ringgit, or around 75 billion US dollars, which is far, far below the entire bulk load of external debt the country actually holds. Therefore, we could already conclude that the financial status of the federal government and its public enterprises is actually in the safe zone when it comes to its foreign borrowings. Then one may raise a question: where is the remaining debt coming from? Well, you might have already guessed it. It is directly tied to Malaysia's private sector. The other holders of these debts are owed to Malaysia's banks, estimated to be about $57 billion to the financial industry and around $44 billion to the non-financial industry. This concept is almost the same as Singapore, which is a small country known around the world for being the financial hub of Asia. And it holds an external debt of over $1.7 trillion, over $1 trillion of which comes from its banking industry. What does this mean? Well, it is because when a foreign individual opens up a bank account in Singapore or Malaysia, that individual which deposits money would register as an external debt to the country, which is why Singapore has over $1 trillion worth of external debt, as it is tied down to its banking sector, or we can say that it is tied down to foreign depositories. However, these debts so far still do not add all the other smaller details in the entire external debt of Malaysia. There are other factors, but they are rather small and comprise factors such as trade credits, IMF allocations of SDR, and others. These others are estimated to be $33 billion. Moving on, the foreign depositories are also applied to Malaysia, and although the country is not on par with Singapore's overall financial status, its banking sector has still been rising steadily over time. The total deposits made by non-residents are approximately $23 billion. Finally, we must also not miss out on the non-financial owed debts, which are tied to Malaysia's own private corporations, as they too seek to borrow money overseas, sometimes or most likely from Singaporean lenders. They use this money to funnel their business to grow and some other agendas that may suit the need to borrow money. The remaining debts, as reported by the Central Bank of Malaysia, come in many other forms. Either way, these are the very basic concepts of what Malaysia's external debt is composed of. These are just the summary of Malaysia's overall external debt. Of course, the very mundane details of each and how the debt looks like, where it came from, and what its interest rates are unfortunately not accessible to the public. The data that we collected came directly from the Central Bank of Malaysia, which only showcases how much the country's external debt is and what the types of debts are. Some debt instruments registered are like securities. What we have yet to mention, however, is that while indeed Malaysia has all of this external debt at play right now, it is also a holder of what is called external debts. External assets are defined as the types of instruments that they hold overseas. This could be through investments, loans, stocks, and many more. It is estimated that these external assets are around 230 billion Malaysian ringgit, or $51.1 billion to the latest data around 2021. These external assets are denoted likewise through many factors, such as investments made overseas, loans and financings made, and so on. But anyway, this still shows how Malaysia is trying to balance out its overall net position by also trying to hold external assets and not just taking in external debts. Finally, there are also other subsectors such as direct investments in the form of both assets and liabilities, which at a quick glance is just estimated to be around 688 billion Malaysian ringgit, or $153 billion for direct assets. All of these investments can be attributed to the banking sector, private investments, loans throughout government bonds, or it could also be because of Malaysia's own sovereign wealth funds, which are known to be the Khazanah Nasional Berhad, as it holds more than 100 billion Malaysian ringgit alone. But going back to our initial question, was it due to political instability, mismanagement, or corruption? Or was it because of Malaysia's economic rise? Well, we could point to the latter. It could really be due to the country's rising economy. Most important, however, is the country's banking industry, which holds $57 billion in overseas borrowings. These could, in very simple ways, be attributed to Maybank, the country's single largest financial institution. Furthermore, we can also conclude that while it is the second highest in terms of external debt to GDP in Southeast Asia, it is not truly a systemic risk for the country. One final thing we have yet to cite is the debt service ratio, which is a concept that simply calculates how a country can repay these debts, and as of the latest data, it is at 12.3%. In comparison, other years had higher service ratios. Around the third quarter of 2016, the country had a debt service ratio of over 30.8%. But anyway, thanks for watching.